Hi ladies and gentlemen, this is Game of Trades, and this is going to be a longer term view of the US economy, and I'm going to show you exactly why we will see a massive opportunity in the next 3 years to be in the stock market. This is the kind of opportunity we'll get maybe 2 or 3 times in our lifetime, and I strongly believe that we'll be able to take advantage of this fully. So for a brief introduction, I'm going to first show you a diagram showing our long-term productivity as a society compared to the long-term debt cycle and short-term debt cycle. So the idea is that our society, our economy, has a steady growth of productivity over time, and that a long-term debt cycle forms around this productivity growth. And along this long-term debt cycle, we have short-term debt cycles forming as well. And I think this simple concept is very important to understand the historical data we have on the S&P 500. And if you understand that this is a natural phenomenon and that this has been happening for a long time in our economy, then you're going to understand everything I'm about to say. So I'm going to put this diagram on the side for now so you can compare the historical data of the S&P 500 I'm about to show you. Now I'm going to zoom out on the monthly chart here. So each candle is a month, so we're going to go back very far in history, around to the beginning of the war right here. And the first thing I'm going to do on this chart is try and put this productivity trend line along it. And you can see we have seen steady growth in the S&P 500 over a long period of time. So we're going to put this productivity trend line right here. And you can see that if I adjust it a little bit, I can actually make it as a line that goes through the middle and acts as support at times and acts as resistance at other times. Not all reactions are perfect, but we do have many on the dot reactions. And recently we have broken that trend line. If you want to take that into account into your long-term analysis, that is something you can do. Now what I find much more useful is putting this line as a trend line at the bottom. And so when you have it like this, you're going to capture many reactions, many bottoms of major historical events like the 1929 crash, the 1937 crash here, 1973 crash, and more recently the 2008 financial crisis. So this is a valid trend line, and if you zoom in, what's very interesting is that had you seen this trend line before, you could have timed the bottom of the 2008 financial crisis almost perfectly. And so this is why I think going back to the long-term charts every once in a while for a retail trader is very important, and it really gives you that step back you need to really get a grasp of what's going on in the longer term. Before I go on, make sure to like the video if you enjoy this type of longer term analysis. I know I love making this kind of video. I love looking at the bigger picture on the S&P 500 and try and draw conclusions into the future based on the past. That is what I love doing. And so if we try and draw out the market cycles along this chart, we can do that pretty easily. We start here with a period of economic stagnation. We have growth, then another period of economic stagnation, and we have growth, then another period of economic stagnation, and then we have growth. And you can also call these periods of growth secular bull markets. These are very long periods, 20 to 25 year periods, where you get an overall increase in productivity for a long period of time in our society. And a perfect example of that, I'm going to clear the arrow in the chart. A perfect example of that is the computer that started being mainstream around here and the internet that started being mainstream around here on this chart. And you cannot argue that these two man-made inventions did not boost our productivity in the long term. They absolutely did. Now, as a technical analyst and as a trader, I have to suppose that we will stay above this trend line as long as it hasn't broken. There is no reason to suspect a potential break of trend line until we see actual signs of a potential break, which is definitely not the case for now. Now, obviously, if we do start breaking this trend line, then that could definitely open the door for a secular bear market. And so the stock market would likely trade sideways or even down for a period of 10, 20 years. We would likely call it the US lost decade, just like in Japan, which had the Japanese lost decade, and then productivity would hopefully pick up again at one point in the future along the same kind of trend line. Now I'm going to highlight specific periods of economic stagnation in history. So we're going to zoom out and clear this chart again, and we're going to draw nice, beautiful rectangles around the periods of economic stagnation. So we're going to start here after the at the beginning of the First World War here, where we had a prolonged period of economic stagnation all the way to 1942, where the secular bull market began. We then have another period of economic stagnation starting right here in 1964 and going all the way to 1982. We can include this last bear market right here. And we have a final period of economic stagnation going from the top of the dot-com bubble right here and all the way to the potential bottom of our next bear market, which would be in around 2022 or 2023, depending on how long it lasts. Now, I'm going to highlight 3 specific characteristics in each of these periods and then compare it to what we are seeing now and to what may happen in the near future and how we can take advantage of that. So the first characteristic is relatively obvious, and that is that between the beginning and end of these periods, the price changes very little. You can see from 1914 all the way to 1942, we have almost no growth in the S&P 500. The arrow is horizontal. We can see the same thing here from 1964 all the way to 1982. We have very, very little growth. And we're likely going to see the same thing here in 2020 if the bear market lasts all the way to here. That will be very, very little growth from the top of the dot-com bubble to the bottom of the 2020 recession. Now, the second characteristic is fairly obvious, and that is these periods of economic stagnation last around 20 to 25 years. Here it lasted around 26 years. Over here it lasted a bit shorter, 19 years. And again, here, depending on where this bear market will end, it's going to last around 22 to maybe 23 years. And you'll also notice that the periods of growth between the periods of economic stagnation also last around 20 to 25 years. Now, the last characteristic that I want to highlight is a little more subtle, and it's simply the fact that we come back and test this productivity trend line before beginning the secular bull market. I'm going to show you exactly what I'm talking about. You can see in 1942, after the 1937 stock market crash, we had a test of this productivity trend line. We have the same thing here after the 1980 bear market. We have a test of this productivity trend line before beginning the secular market that lasted all the way to the dot-com bubble. And now in my ideal scenario, we would likely see the same thing. If we hit my bear market targets, which I've been talking about since this period right here, since we've been in a bull market, I've been talking about these bear market targets, and it seems to be playing out pretty well right now. But this would be the zone that we would likely visit at the end of the bear market. And so again, that would fit into all the characteristics that I laid out previously. The fact that the price did not change much from the beginning and end of the economic stagnation, the fact that this period lasts around 20 to 25 years, and the fact that we hit this trend line before starting a secular bull market. So now I'm going to clear the chart and zoom in a little. So as you know, I've been talking about a recession since this period right here. I was talking about the bearish divergence that was forming on the MACD, the fact that the greed was too high in the markets, and many, many other factors. And that seems to have been confirmed recently with the break of this recent bull market trend line. We clearly broke it on the S&P 500 and we're clearly below it right now. So I do think my bear market scenarios will happen. Now I'm going to lay out two different scenarios for you guys right now. I'm going to adjust this trend line. The first scenario would be that we revisit the highs of the dot-com bubble. This would be the worst case scenario for a bear market in my opinion. And I think this would have been the case if we had not seen government intervention in the past couple of weeks. We would have seen a very massive drop very quickly all the way to very low levels. Now the second scenario that I have is that we hit this support level that we formed at the bottom of the 2015 consolidation right here, and that would look something like this. It would be more of a controlled bear market, and then we would again reverse off of this productivity trend line to go higher. And I think this is definitely the most probable scenario considering the stimulus package and the government intervention with quantitative easing that we're likely to see in the years to come. That's likely to bring a steady move down. Now obviously it's not going to look like I have it on this chart. We may see some kind of a double bottom pattern like this before turning around, or some kind of a nice controlled wedge pattern all the way to the bottom. It's starting to get a little bit messy, but you get the point. It's very difficult to say what kind of recession we're going to have right now, but this is definitely something I'm going to be covering extensively in the years to come. What we can say for sure is that we're unlikely to see all-time highs for another 5 to 6 years, I think. And another thing you can say is that watching this productivity trend line is extremely important if you want to time the bottom of this recession perfectly. And as I covered in the rest of the video, I do think we're going to test this productivity trend line before starting a secular bull market potentially. And so this could definitely be the lowest possible price you could have for the bull market to come. Now that's about all I wanted to cover in this video. I hope you guys enjoyed. If you did, make sure to like and subscribe if you haven't already. In the meantime, good luck on your trading and see you next time.